Welcome back to Father and Son Investing. Over the last few years, inflation has eaten into the way that many of us are able to invest. In today's video, we're going to talk about just how much inflation has eaten into that. We'll talk about some articles in the NPR that appeared today, as well as a survey of American households showing just how much that inflation has eaten into our ability to save. We'll also cover the way that inflation has increased and compared to wage growth, all of that affecting our ability to save. And then we're going to wrap up our discussion by talking about some ways that we can combat inflation and increase the amount of dollars that we can save each month. We're going to use this budgeting percentage pie chart for an analogy. I want you to imagine that this pie chart is actually a sponge, and that each little bit of water that we drop on there is a piece of inflation. So if we drop some water on the housing part of this sponge, you'll know that the housing part of this sponge is going to start to inflate, maybe go from 25% to 35%. And say we drop some water on our transportation costs, and that part of the sponge starts to increase in size, or our food costs. You get the idea here. As all of these other areas start to increase in size, they will start to crowd out our ability to save, making our savings percentage less in comparison to the size of all of these other parts of this big sponge. Now, the good news is that certainly the rate of inflation has been on a nice steady decline, as shown here in red, going from that high of 9.1% down to most recently to 3.1% year over year. The bad news is, though, is that inflation is still increasing even though the rate of inflation is coming down. So each month we continue to add just a little bit of water to this sponge in our analogy, crowding out our ability to save. Now, one obvious thing that could help us increase our ability to save here would be that if wages were keeping up with inflation, which until just a little earlier in the year, that was not the case. We see this long stretch of time here where wages in blue increase were just not keeping up with the rate of inflation. And this cumulative gap here between all of this time has caused a huge deficit in our ability to save. Now, recently, the rate of wage increases has been higher than the rate of inflation. If that continues to go on, then we will find in 2024 potentially that our ability to save goes up as our wages go up. But the problem here is that all of this inflation has been cumulative, adding up month over month and year over year, price increase on top of price increase. An article that appeared today on NPR says, inflation has cooled a lot, so why do things still feel so expensive? It goes on to talk about disinflation. That's what we call the decrease in the rate of inflation. It's not deflation, it's just decreasing in rate. But most Americans, I think, according to this article, are looking for deflation, prices to actually come down. However, falling prices are not necessarily a good thing. In fact, Japan has struggled with deflation, falling prices, since the early 1990s. What's the problem with deflation or falling prices? The problem is that we all would think, well, if I can buy a washing machine in 6 months for less than I can pay for it now, then why would I pay for it now? That becomes an endless spiral where people are withholding, spending money, waiting for prices to come down. And since the U.S. economy is really built on consumer spending, you could see how that could be a terrible thing for us. Nevertheless, there are some things that are significantly falling in price. For instance, eggs, down 22% year over year. The cost of major appliances and airfare, down 10% and 12%. However, there are some things that if you've been paying attention, have been increasing more than that rate of inflation. For instance, look at auto insurance here, up 19% year over year. Admission to sporting events, up 16% year over year. And if you're paying for someone to do your taxes, 8% increase year over year. Some more examples. This is from the Bureau of Labor Statistics. This was actually the impetus for this video topic. They put out a report each year that shows what the consumer expenditures were for the calendar year. It actually doesn't come out, though, until September of each year. This latest report then shows that 33% of our spending goes for housing, 17% for transportation, and 13% for food. And this graph shows the annual percentage change in expenditures from some selected components. Notice that the only one that went down here on their selected components, entertainment, was down 3%. Everything else on this list here, people were spending significantly more. Look at housing, 7% more, transportation, 12.2% more, and food, almost 13% more. Narrowing down on that transportation category, notice this huge increase in the cost of public and other transportation, 87% more. Now, the nice thing about the report this year is they break it down by the size of a household. So not only can you see what it looks like for all households, but they break it down by one person, two person, all the way up to 5 or more people. This report also breaks things down by quintiles of income. So you can see the lowest 20% and the highest 20%. Notice here that for almost all quintiles, other than the lowest, the percentage of increase in income was less than the percentage of increase in expenditures, showing us again that wages were just not keeping up with the rate of inflation. Now, the problem with inflation eating into our ability to invest is that every dollar that we don't save now loses that ability to compound for the future. What am I talking about? Here's an example from the folks at Vanguard. $1 could grow by retirement, but it depends on what age you contribute it. If you start when you're 20, that $1 in retirement will be worth $5.84. But if you wait because inflation has been eating into your ability to invest and you assume I'll make more money later, well, that $1 is only going to be worth $3.95. Now, that inability to compound your savings actually compounds. Let's take a look at this. With time, you can invest less money but have more to spend in retirement. What are we talking about? Let's take this example. A person saves $10,000 per year starting at age 25, but they're only able to do it up to age 40. Something happens, some financial difficulty, health problems, you name it, everybody has life come up. So at age 40, they're not able to invest anything else. Obviously, they've only invested a total of $150,000, but when they retire at age 65, they will have more than $1 million. Now let's take your friend who isn't able to start until age 35 investing that same $10,000 per year, but they managed to keep it going until they're 65. Obviously, they've invested $300,000. What's their total at retirement? It's only $838,000. That's the effect of compounding and starting it early. And every dollar that inflation takes away from you now just eats into your retirement savings. Now, going back to our pie chart sponge here, what can we do to make it so inflation is not eating away at our ability to save? First of all, I would recommend pay yourself first. Actually, first of all, at least for me, I pay tithing first, which is 10% of my income. But following that, pay yourself first. Don't let your other bills eat into your ability to save for the future. However, for many of us, I realize that that's not possible based on the way our budgets are already running, or just keeping up with life and the way that inflation has been increasing. So what can you do? Let's look at the biggest piece of the pie chart here, our sponge, and that is housing. What can you do? If you are renting, let me just say, be willing to move. For instance, last December, my wife and I are renting a townhome while we are building a house. And when our lease came up, our rent was going to go up significantly. Rather than pay that rent increase, we decided we would move to a place that was going to be much cheaper. Ironically, we got an email from the company that was renting to us saying that they did not want to lose us as renters and what could they do to keep us. It was already too late. We'd signed a lease on another place. But be willing to move. That may keep your rent from at least increasing if you're willing to move. Probably not a decrease in your rent, but at least it won't be adding more water to the sponge here. If you are currently owning a home, you have a mortgage, well, realize that there's only about 18% of us that have a mortgage that is currently more than 5%. But if you're one of those 18%, realize that mortgage rates have started decreasing recently. And if projections are true that the Fed will be decreasing the Fed rate throughout 2024, realize that mortgage rates may be coming down. Get yourself prepared now to be able to refinance. Make yourself qualify for the rate of a loan that you're looking for. What else can you do? Another big piece of that pie here is insurance. We saw how much automobile insurance is up. I've also read about increases in homeowners insurance. What can you do? Take a look at your deductibles. Now, don't increase your deductibles so high to something that you could never afford in your budget. But let's say you have a $100 deductible on your automobile, but you could afford a $500 repair bill. It might be worth it to you to increase your deductible to bring down your insurance. Similarly, on a home owner's insurance, increasing your deductible again to something that you could afford may be a wise move in terms of bringing down the cost and keeping that from eating into your ability to save. Let's take a look at utilities. I would encourage you to look at each of your utility bills and see what you're spending there. It may be that you can decrease your usage, or there may be some things there that you can just decrease the monthly rate. That might be a cell phone bill, that might be a cable bill. For instance, we were using DirecTV as our streaming service. That rate went from $35 a month when we first started a few years ago to $98 as the most recent bill. We decided we would go ahead and dump DirecTV and go ahead and do Hulu Plus Live TV. In fact, we were already paying for Hulu with Disney and ESPN Plus. So adding Hulu Plus Live TV made a significant savings in our monthly bill, about $30 a month. Now that might not sound like much, but that $360 per year can add up if you're able to put that into savings and get that compounding going. I won't go into more details here because I think you're starting to get the idea of being able to decrease some of these expenses that you might have, allowing yourself to keep your savings rate up. Let's wrap this up then. The take-home message for today's video is realize that every dollar that you are not investing now because of inflation eating into your ability to invest is compounding. What's the take-home message for today's video? Realize that every dollar that you are not saving now because of inflation eating into your ability to invest has a negative compounding effect on your future retirement. And I showed you how that works. And number two, realize that in 2024, there may be some opportunities for you to decrease your spending in that pie chart sponge that we showed. Share this information with a young person in your life. I think I've shown you just how important it is to get young people investing early and do it often. And until next time, enjoy your investing.